This is my silver notebook from the last cycle. I watched the metal sit there like dead money for years, and if I'm being honest, I deserve to miss the move. Not because silver was invisible, but because I kept waiting for the perfect headline, the perfect dip, the perfect confirmation that never really comes. Today, I'm going to give you the 7 signals that tell me silver is no longer behaving like a forgotten asset. But signal number 5, that's the one most investors are going to laugh at until it hits their account statement. Today is Monday, May 25th in New York. Comment the day and date you're watching from, because I want to see how fast this story is spreading. And one more thing before we get into it. If you value this content, support it by subscribing and commenting. Our John AG. That's it. Simple. Now, I need to set the table here. This is not a screaming, buy bars, hide in a basement video. That's emotional. This is about reading a market that has spent years teaching people to ignore it, and then suddenly starts acting like ignoring it might be expensive. Because here's the thing. Silver does not usually announce itself politely. It sleeps. It frustrates everybody. It fakes people out. It runs just far enough to bring in hope, then pulls back and humiliates the late buyers. And then, when enough people stop believing, it moves in a way that feels unfair. That's the part I think we're approaching now. Let's go. So here's what most people are missing. This is not just a silver chart story. It's a portfolio trust story. For decades, investors were told the normal plan was simple. Own stocks, own bonds, rebalance, stay patient, let time do the work. That model worked beautifully when bonds behaved like shock absorbers and inflation stayed quiet enough that nobody had to think too hard. But when government debt gets heavy, when long-term yields start acting nervous, when gold is already being treated like a reserve asset again, and when silver supply keeps failing to meet demand, the old comfort blanket starts to look thinner. Not useless, just thinner. And thinner is enough to change flows. Signal number 1, silver is trying to stop acting like the weak brother of gold. For years, gold got the respect and silver got the excuses. Gold was central banks. Gold was safety. Gold was the serious metal. Silver was the volatile cousin that showed up late and ruined the mood. But lately, that relationship has started to shift. Based on recently published market numbers, silver has been getting support from both sides of its personality, the monetary side and the industrial side. That's rare. And that matters because silver is not just a fear trade. It's used in panels, electronics, power systems, medical applications, vehicles, and a long list of boring places where real demand doesn't care about YouTube thumbnails. When the metal is wanted by investors and industry at the same time, the price can start moving differently. Not in a straight line, never in a straight line, but differently. Signal number 2, the supply picture is tighter than the average person realizes. I'm not saying there is no silver in the world. That's nonsense. There is silver. There are vaults. There is recycling. There is mine supply. But the question is not, does silver exist? The question is, how much silver is available at the price people are used to paying? That's the difference. A market can have metal and still be tight. A market can have supply and still need higher prices to pull it out. According to the latest publicly available industry surveys, silver has been dealing with repeated annual deficits, and even when some demand areas cool off, the cushion is not exactly comfortable. That's not a guarantee of a moonshot. It's a pressure cooker. And pressure cookers are boring until they're not. Signal number 3, silver miners are starting to matter again. This is where people make mistakes. Listen carefully. Miners are not silver. A mining stock is a business wrapped around a commodity. It has costs. It has management. It has political risk. It has debt. It has dilution. It can disappoint you even when the metal is doing fine. But when the metal starts moving and margins expand, miners can wake up before the mainstream crowd understands what changed. The key part is leadership. If silver, silver funds, and silver miners all start confirming each other, that is different from a single panic candle. A single spike can be speculation. Confirmation across related assets is more like footprints. Not proof, footprints. And when footprints keep showing up in the same direction, you should at least stop pretending nobody walked through the room. Signal number 4. The bond market is the quiet villain in this story. Everybody wants to talk about one headline, one war, one central bank sentence, one oil move. Fine. Headlines move markets for a few days. But the bigger issue is the bond market telling governments, your debt is not free anymore. Recent Treasury data and budget projections show interest costs becoming a much larger piece of the federal machine. That changes psychology. Because bonds were supposed to be the calm part, the grown-up part, the place money ran when stocks look shaky. But if long bonds are falling at the same time people are worried about inflation, then the investor has a problem. Where do you hide when the hiding place is shaking? Now, don't misunderstand me. Treasuries are still one of the deepest markets on earth. I'm not saying they disappear. I'm saying the emotional contract has changed. And when that contract changes, some money starts looking for assets that can't be printed with a vote, a speech, or a crisis meeting. Signal number 5, and this is the one people will mock. The big silver move may not need a perfect recession or a total market collapse. I know that sounds strange because people love dramatic stories. They want the stock market to crash, bonds to implode, currencies to melt, and silver to rocket the next morning. That's clean. That's cinematic. That's also not how markets usually work. A lot of major tops and rotations are messy. They grind. They confuse people. Stocks can make new highs while beneath the surface, leadership is narrowing. Bonds can bounce while the long-term trend still looks damaged. Gold can pause while the reason for owning it becomes stronger. Silver can pull back sharply and still be building a new range. That's the part most people can't handle. They want one clean signal. Markets rarely give that. They give feedback. And the feedback right now is that real assets are no longer just an emergency trade. They are becoming a portfolio discussion again. Signal number 6. Inflation is not only the grocery store number. This is where a lot of people get tricked. They stare at the monthly inflation report and think the story is over if the number cools for a moment. But asset inflation, currency dilution, deficit spending, and money supply growth work on a slower clock. The M2 money stock has expanded massively over the long run, and even after tightening periods, the system still depends on liquidity more than most people want to admit. Money does not vanish from human desire. It rotates. Sometimes it rotates into technology, sometimes into houses, sometimes into long bonds, sometimes into commodities. And when investors start believing paper promises are crowded, expensive, or politically fragile, hard assets suddenly look less boring. But let me challenge the extreme version. Anyone telling you silver must go to some wild price immediately is probably selling certainty, not analysis. Silver can be bullish and still punish bad entries. It can be in a real uptrend and still drop hard enough to make over-leveraged traders quit. It can be cheap versus history and still stay frustrating longer than your patience lasts. That's why the question is not, do I buy today? No. The question is, do I have a plan before the crowd panics into one? Signal number 7. The crowd still does not believe the commodity story. That's actually useful. When everybody already agrees, the easy money is usually behind you. But right now, many investors still treat commodities like a side note. They see oil jump and blame headlines. They see gold rise and call it fear. They see silver move and call it speculation. Maybe some of that is true. But from recent market updates, the broader commodity complex has been firmer than the casual viewer realizes. And here's the key. A commodity move that starts before everybody talks about it is different from one that starts because everybody talks about it. If oil, copper, gold, silver, agriculture, and miners all begin improving in different ways, that is not just a single headline. That's money searching for a different home. Now, let's talk about price without getting stupid. Could silver go much higher over the next few years? Yes, absolutely. Could it overshoot in a mania? Of course. Silver has a long history of turning calm investors into emotional gamblers. But do I need silver to go to some fantasy number to make this thesis matter? No, I don't. If silver simply reprices into a higher zone because supply is tight, industrial use remains sticky, gold keeps institutional attention, and bond confidence stays under pressure, that alone can be meaningful. The dangerous part is not missing a mythical straight line to the sky. The dangerous part is having zero exposure, zero plan, and zero understanding when the market starts forcing the conversation. Here's what I would not do. I would not chase every green candle. I would not use money needed for rent, debt payments, taxes, or emergencies. I would not buy miners blindly because some chart looks exciting. And I definitely would not assume physical silver, silver funds, and mining stocks carry the same risks. They don't. Each one has a different job. Physical silver is about ownership and patience. Funds are about liquidity and simplicity. Miners are about leverage and business risk. Futures are for people who actually understand futures, not people who watched 2 bullish videos and suddenly think margin is a personality trait. So here's the practical way to think about it. Build a thesis. Choose your vehicle. Decide your position size before you get emotional. Decide where you're wrong before the market tests you. And if you're new, start small enough that a normal pullback doesn't turn you into a forced seller. Because the market's job is not to reward your conviction. The market's job is to expose your weak spots. If your weak spot is impatience, silver will test it. If your weak spot is leverage, silver will find it. If your weak spot is needing the crowd to agree with you, silver will leave you behind and then tempt you back at the worst possible moment. Let's summarize all this. Number 1, silver is starting to act stronger relative to gold than it did for years. Number 2, repeated deficits keep the supply side tight enough to matter. Number 3, miners can confirm the move, but they are not risk-free. Number 4, Shaky long bonds change how investors think about safety. Number 5, silver does not need a perfect crash to reprice. Number 6, money supply and deficits are part of the deeper inflation story. Number 7, the crowd still treats commodities like a side room, and that may be the opportunity. These are not stone predictions. These are survival rules for a market that may be entering a new phase. Free information is worthless unless you turn it into a plan. So, comment below and tell me this. Are you holding physical silver, a silver fund, miners, or are you still watching from the sidelines? And if you're successful, share your success story in the comments so others can stay motivated. Look, I am not telling you to worship silver. I am telling you to respect the setup. There is a big difference. Worship makes you blind. Respect makes you prepared. The people who usually get hurt are not the people who disagree. They're the people who agree too late, size too big, and then panic on the first ugly pullback. So don't be that person. Don't wait for every television panel to suddenly discover silver. Don't wait for your neighbor to ask about coins. Don't wait until the chart is vertical and your emotions are doing the analysis for you. Study it now, plan it now, size it now. And if the thesis breaks, admit it quickly. Subscribe to the channel if you want more calm analysis in markets that make people emotional. And remember, this is for education and market perspective only. I'm not your financial advisor. I don't know your situation, and nothing here is a personal instruction to buy, sell, or hold anything. Use your own judgment, protect your downside, and never let a powerful story replace responsible risk management.